Great, awesome. So it's 9 o'clock, and we're just waiting for everyone to join in. As we can see right here, there's almost 100 plus registrations. So I'm hoping all of you would show up, and we're just waiting for all of them, all of the attendees to show up. But this is going to be a very interesting session here. Our panelists are ready. I hope all of you guys can hear my audio and see me as well. So without much ado, we have a packed up session, so I'm not going to take much of a time. I'm hoping that the rest of the folks who had registered will show up in throughout the event, but I don't want to waste any time, so I'll just right ahead jump into the session. So like all of you know, my name is Mani Karthik, and I'm running this community backtoindia.com, which is essentially a community effort for, or a group huddle effort, so to speak, for NRIs to move back to India. And we're trying our best to share information or make it a hassle-free process for anyone who is willing or planning to move back to India in the next couple of weeks, months, or years even. So I'm sure that all of you guys have registered on the community, but if there is anyone who haven't, please feel free to register on backtoindia.com. That's where all the action is. But today's session is really interesting. We have two gentlemen joining us today, Mr. Pratik Dodia and Mohit Ralan. Pratik is the financial planner, catering for, he's an expert basically, catering to the NRA audience and high network individuals in India, and he's based out of Mumbai, I believe, if I'm not wrong. And we also have Mohit Ralan, who is CIO and the founding partner at TIW Private Equity, and he's also amazing with his knowledge. So this session is going to be all about financial planning and where to put your money in and how to make the best of your hard-earned money for all of our NRIs. So not going to take any much time. I'm going to hand over to Pratik. Pratik, feel free to take over. Feel free to share your screen. I'm just going to make sure that you have the rights to do so right now. Can you see the share screen option right now?
1 second. Okay, let me just. No, it's not yet showing.
How about now?
Yeah.
Okay, great. Yeah, go ahead. I'm going to put myself on mute. And before that, to all the people who are attending, if you have any questions at all, feel free to ask it in the Q&A box, and I'll be curating it towards the end of the session. We'll be asking both these experts all the questions and making the most of it. So just keep that in mind. Over to you, Pratik.
Yeah. Thanks, Mani. Thanks a lot for this warm welcome. Hi, Mohit. How are you doing? A very warm good morning to everyone in US, Canada, various parts of the world from wherever you're joining. And I'm really heartened to come on this platform again to share my insight. This time, we'll be discussing in terms of investment options for NRI. Not wasting much time, let me just quickly start in terms of today's highlights, what we are going to largely cover. So being a wealth manager and financial planner, we are going to discuss today what are investment options for NRIs in India, asset class, why equity specifically, then obviously time in the market rather than timing the market, missing the best days, negative, positive return, compounding, diversification, asset allocation, financial goals, and how you create your alpha with help of alphabet investment, and just a little bit about ourselves in terms of team strength. And then I'll introduce Mohit, with a unique buyout strategy, one of its kind in India. So just to start with, obviously, these are some of the questions which every investor generally looks for when he's investing. So what is that investor is looking for actually? Is looking for A, transparency, B, liquidity, C is to generate better return to alternate like a bank deposit, because that's the safest alternate what we look at. So alternate is bank FD. Current NRE bank FD interest rates are close to 5%. We are looking at low risk options where basically obviously there's no risk to the capital and generate better return than bank FD. No currency risk. This is very important. I'll touch upon this and probably in later part, Mohit will cover as well, during his presentation. Regular cash flows. I think these are very important. While investing, it's very important that we get a regular cash flow via dividends and capital gains or profit booking. And obviously, we'll talk about no currency risk in detail in later stage here. Okay, so what are the asset classes one can look at largely, whether you are investing in India or anywhere globally, So you have largely four asset classes, which is we classify as real estate, gold, fixed deposit, and equity. Okay, each of the asset classes have its own advantages and disadvantages. Not to get into too much in terms of detail, obviously we all know real estate has its advantages that it's a hedge against inflation. It gives you better return than inflation. Gives you some tax benefit in India if you're an Indian citizen. But obviously there are disadvantages like illiquidity of the real estate. We know when we need the money, it's difficult to sell the property at times because of the the size or the capital requirement of the property, and there's no liquid market like equity market where you can go and sell it tomorrow. Gold, obviously, we have seen gold's importance always, even in the recent times when the COVID breakout happened, So gold always is a hedge against inflation or global currency, against dollar. It's a hedge when there is a instability across the global economy or there is some uncertainty around the economy. That's when the gold has always proven its metal. So it's more of a hedge, what we feel against, and some portion in gold is always required, as a asset class. Obviously, that disadvantage that it doesn't have any regular income or cash flow. It doesn't pay you out any dividends, any cash flow. So it's just you're buying and holding. It's more of a social status recognition for a lot of people. And yes, you have to remain invested for longer period without expecting too much in the price appreciation. Fixed deposit, obviously, don't want to dwell. I'm sure all of you all know about fixed deposit. Fixed deposits are nothing but a secured, high liquidity, a short return kind of a thing. But obviously, tax efficiency, no capital appreciation, inflation are the key risk which fixed deposit doesn't cover. And especially in a low interest rate environment where we are seeing interest rates coming down, fixed deposit doesn't really hold too much of a inflation or hedge or protects your capital in terms of real return. Let's talk a little bit about equity also. Equity, obviously, we know has been one of the best investment asset class over a longer period of time. We have seen the wealth creation, what it has been able to generate, whether you look at any economy, whether it's US, India, or globally, It's a best inflation hedge, very high liquidity, but obviously disadvantages, it can be very volatile and returns can be lumpy, in terms of returns always lumpy. They are not a straight linear curve or line what we see with other asset class, and your holding period time has to be longer. So let's try and understand each of the asset class, how they have done over a period of time. So just to break you in terms of breakup of the asset classes, okay, fixed deposit, bonds, NCDs, these are some of the investment options you can look at in India in form of bonds or FDs. Real estate obviously can be residential or commercial. Largely, we are looking for two options out here. Is we are looking at a capital appreciation and rental yield. Then obviously mutual fund is one of the most safest and preferred route by a lot of investors investing into India. It helps asset allocation strategy through diversification, and gives you better risk adjusted return. Obviously, you want to invest in good long term direct equity companies where you can actually create wealth over longer period of time and buy strong fundamental businesses. And obviously, there are certain investment options like which are private equity, where Mohit is going to touch about it. So buyout strategies as a what, how it functions, and this is one of the very important dollar investment option which will be taken by Mohit in the later stage. Uh, okay, this is just a breakup of in terms of assets for last 30 years. We are looking at last 30 years performance. If someone had invested for last 30 years, equity in India has done a CAGR of 13.7% return since 1990 till 2020, a CAGR of 13.7, and US equity is done about 13%. So they have been by far the best asset class as equity. I don't want to talk about India and US. It's not a versus India versus US. It's equity as asset class, whereas debt has also done well in past where interest rates were very high in India. Obviously, now interest rates have come down, so you can't expect this kind of return. Now our interest rates are in range of about 5-6%. So probably return range should be in that space going ahead. Even cash today, your bank cash reserve ratio or whatever has come down to your saving ratio is about 2.7. So this rates have also reduced drastically from what it was, comparatively. And obviously gold has done about 10% return, which is basically beating your inflation over a longer period of time. What is important is this positive observation for 3-year holding period, So most of the 84% of the time, if you would have invested equity for over 3-year period, this observation always remains positive, and your average return has been better than inflation, 12 to 13%. This is what I'm trying to highlight out here. Obviously, we'll talk about this in detail on later slide in on Indian equity. Just to little talk about Indian equity. Let's talk about what has happened. If you look at Indian equity, so which is a Sensex, which is the benchmark index, it has generated about 15% compounded CAGR return with an inflation of 6%, over last 20 years. This is, I'm talking about 100 rupee invested in 1999 has become 1650 in terms of nominal terms and 560 in terms of post inflation. So your return is almost 5.6 times your initial investment, and in nominal terms, it's almost 16 and a half times, in terms of your investment. This has all been achieved in spite of what we have seen in the last 20 years. 9/11, we saw, global financial crisis, eurozone crisis, Brexit, and COVID, obviously recently. In spite of all this global major, we can see the events what has impacted the markets. In spite of all this, market has been able to deliver a 15% CAGR return. However, changes are the most would be traded, So basically, see, ideas that eventually these trades tend to happen due to various changes in terms of trades, or whatever global, recent pandemic happened. But we shouldn't let our emotions get in way of our investments, So we have seen that after the dip in the March, how markets have recovered sharply. So people who have stayed away from emotion and, by not driven by the fear and greed factor, have actually made very good returns, by staying invested in the market. So time in the market is what is more important rather than timing. It's a very old age saying, So I would like to highlight here, these are various starting or points of investment. If someone would have invested in 2001, 2009, 2011, 16, or recently as March 2020 during the COVID times, there are various levels one would have entered in terms of market for an investment point of view. Obviously, let's not look at recent one because this was very difficult or an exceptional, time, investor would have timed it. Difficult to time that. But if you look at long-term returns, and this what we are talking about return is total return. This which includes not only the market returns but dividend as well. So this values are total return index we have taken, including the dividends what companies have paid out in the index. So if you would have invested, your CAGR return has been in excess of close to 15%. In 2011, as recent as about 10 years back, if you would have invested, your returns are close to 15% CAGR. In 2009, it would have gone as high as 18, and longer you stay, your returns are much better and much more stable. Obviously, 2020 was one of those opportunities which got offered, and these are opportunities you want to grab. Always remember that when there is complete pessimism, that is when it's the best time to invest in the markets, and not to think about, or get carried away by emotions, or let emotion comes in your way while making an investment decision. So it helps you to actually generate better return. And someone would have actually entered market in March would have generated about close to 86 to 100% return in period of about close to a year's time. So that's been the wealth creation which can happen by equity. Obviously, this is one of the best saying what I prefer. A stock market is a device which is to transfer money from impatient to patient investor. That's what Mr. Warren Buffett, the greatest investor of all time, he says. So generally, what we have seen, people, if this is what I would like to highlight as a chart. So this talks about the return percentage. So, and this is the holding period. Suppose say you are holding investment for more than 5 years. Anything above 5 years. What are the chances of you making in excess of 14% return? If you hold for 5 years, your chances of making 14% return is almost 37%. But you can see as you move towards right, your chances of making 14% return goes up considerably. Or let's talk about more than 6%, which is your FD. So if your holding period goes up, your chances of making more than 6% has become 100% here. Even more than these are the various, we have taken the various uh, days of investment, we have taken all the possible days of investment in the Indian financial markets, and look at even more than 10% return. If you would have stayed invested for more than 10 years, your chance of making 10% return is almost 83%, and 15 years it's 100%. So as you see, as you move up or your holding period increases, your returns also go up, and your assurity of return also increases. So with equity, it is the time which is more important rather than trying to time the market. Timing doesn't work because it's difficult to always get the bottom and exit at the top. But as long as if you stay invested over longer term period, which is 10-year plus, invariably you will make a return of better than inflation at any time. That is why equity remains to be one of the best class in India as well as globally. Just to talk about what is happening in Indian market, just from a scenario perspective, we have drawn down three scenarios largely. We are looking at a scenario one, two, three. Not to get into too much detail, but what has had happened, what has led to the growth in the economy, or what we are seeing is basically a lower cost of capital. So cost of capital, C for COVID, C for cost of capital. Cost of capital has come down drastically for Indian companies. In last 1 year, interest rates globally have come down, as well as India has got benefited by, because interest rates in India has also come down. So basically, these are the three scenarios what we have taken. If interest rate has come down, your cost of capital now has come down to almost 9%, from 12%, which means much more better cash flow for the companies. So a company which was making a cash flow of 126 now will start making a cash flow of 143 to 153. And obviously that means what happens is your change in the profit or the cash flow has gone up as high as 19 to 30%. So cost of capital, due to low interest rate, cost of capital in India has come down, which has resulted in better profit for the companies, better margins for the company. And this will actually only help in going ahead. Okay, markets in India obviously have been very top driven, polarized market with only top five companies contributing bulk of the return. And that has been the trend last 3 years. We have seen not only in India but also globally. We know in US the FANG stocks have actually gone up, and they are the ones which have taken the markets ahead. But yes, same thing has happened in India. What we have seen is the top five stocks or the top five companies have actually polarized the market in terms of return in last 3 years. You can see the contribution of top five in the return percentage. Almost 80% of the return has come in last 2 years from the top five companies. And in fact, in 2018, they were much more in terms of 152% of the total return. So rest of the companies were negative in terms of performance wise. Obviously, this has led to a dispersion between the returns between large cap, mid cap, and small cap. So we can see clearly, small and mid cap has underperformed in recent past. So clearly, there's lot of value in mid and small cap companies in India. Over longer period of time, definitely they have outperformed or performed close to what Sensex has done or Nifty has done. We expect that going ahead, mid caps and small caps to do well, as they have underperformed in last 5 to 10 year time frame. And especially last 3 years, they have underperformed very drastically compared to Sensex or Nifty. Not to getting too much into detail, but yes, finally we are seeing some profit growth back to the companies in the Nifty. Why? Obviously, as I told you, low interest rate has been one of the reasons. Obviously, and apart from that, due to COVID, a lot of corporates have been able to reduce their cost on the balance sheets. They have cut down their cost. When I say cost, it can be in form of fixed assets, fixed cost office rents, can be variable costs as you talk about various costs which can be travel cost or other cost overheads have come down. So overall the cost for the companies have come down in last 1 year, along with low interest rates have led to better margins for the companies. So profitability of the companies have started increasing. Just little bit, obviously, best time, as in previous slide also I have said that best time to invest is when there is complete panic on the street. There's a lot of pessimism, skepticism around the market. We are still at the skeptic stage. People are not 100% convinced about this market rally. And whenever you have invested, when market falls in excess of 20-30%, we have seen the returns what it has generated in next 3 years. So this year also, we have, when market has fallen by 38%, we have generated almost 100% return already in a year's time. This is just a positive negative return. Not Don't want to spend too much time, but 60% of the time returns have been positive whenever someone has invested in the market. So 60 to 70% of the time you have made positive return if you have invested in the market for a one specific calendar year. What are the key sectors which are looking good or have done doing well in India? Obviously, due to COVID, importance of technology has gone up. We have seen vast adoption of technology across, whether it's a larger corporates, medium size or small. We have seen, corporates adopting technology like never before. Uh, it's become more of a necessity now rather than a luxury in terms of technology. Specialty chemicals, obviously, due to anti-China sentiments and ban due to environmental reasons, India is becoming one of the hubs for the export of specialty chemicals. So a lot of companies are doing well in specialty chemicals. Consumer is an evergreen trend due to rising middle income population, income levels rising, spend obviously is going to go up. That has led to consumption drive, and obviously need of the hour. We are talking about pharma and healthcare, and obviously due to COVID, this has all the more become more in demand. People realize that they need to spend on the healthcare as well as insurance and various other segments. So obviously pharma and healthcare is looking good as a sector. Agriculture, obviously, due to low penetration of COVID, this part of the economy is not got much impacted, and obviously, government has been focusing on the agriculture as a sector with recent policies and reforms. We expect agriculture as a sector to do well, and obviously, last and not least, auto ancillary is one of the key sectors what we feel will do well in India as increase in demand goes up as people rush to prefer a safer option, not prefer a public transport in this time like this. So obviously demand for cars and two-wheelers have gone up in India. Just little bit on the, obviously we have talked about the positive side in terms of return. It's very important to understand negative side. So basically, if you invest in market, there is always possibility that market can fall. If markets fall by 50%, if your portfolio fall by 50%, then it needs to go back 100% up to recover, right? If 100 becomes 50, 50 to become 100, it has to rise 100%. So it is not just about making returns, but protecting the downside. So it's very important to protect the downside. How you do it is by diversification. Okay, asset allocation and diversification are the best tools what greatest investors have always talked about. So whether it is diversifying, in the within the portfolio in terms of companies, whether it's small, mid cap, large cap, across the sectors, whether it's a consumer sector, what we discussed previously in the previous slide, the sectors what we were looking at. Ideas, but maintain discipline to remain diversified. It is very important to maintain discipline when you diversify your portfolio. Stay invested and do it through mutual funds or through portfolios. Create portfolios which are very diversified, and obviously asset allocation. You can look at various asset allocation: equity, debt, gold. Diversify equity across geographies as well, not only India, US, other economies which are doing well. So diversification is very important from a return creation. We have seen times like in 2008 also where stocks went down as low as 52% due to global financial crisis, but gold stood its ground and bonds. So in year like 2008, we have seen that gold and bond have generated return, and obviously then again 2009 we saw equity going back. But it was difficult if you would have asked someone to try to predict what will do well in 2008 or 2009. In 2008, everyone, by start of 2008, everyone was very optimistic about equity, but obviously what we saw led to a correction in the equity market. Post that, obviously, again we saw sharp recovery because markets were way too undervalued. So we saw a sharp recovery in 2009. So, but your average return has been pretty stable if you look at it. If you would have done your asset allocation one third, one third, one third simply across stock, gold, and bond, you would have made this return, which are much more stable returns. What you can control is not returns. What we can control is risk, cost, uh, time what we invest in, and behavior of ours. We cannot control is the return. Return is something which is beyond our control. It is what market determines, right? We can diversify, we can do asset allocation. That should be the focus. Just again reiterating how various asset classes have done, across financial years, or calendar years. Not to get into too much. More importantly, when you do investment, what people generally tend to do is they do invest only because looking at the short term returns what they have generated out of their portfolio. They don't tend to focus on their financial goals or specific need for what they're investing. As an advisor, that's where our job comes in, actually, to identify your key reason or investment horizon. So it is very important that whether you're investing for your retirement planning, whether you're doing your estate planning, or you're doing your any other financial goal, or you are looking for a risk cover for yourself or health, health insurance to cover your risk against medical. These are all the important aspects of financial planning. And we always say that plan, and plan for your better future. That is what we always suggest, and that's how we do it. This is just a sample goal what we are trying to share. So this is a screenshot from our website or a tool what we use for our clients. So once you register as a client, you can actually we can create your investments into a plan, which is we are just sharing a retirement plan for one of our clients. His goal for investment is he has to save about almost 19 cr, and he's almost close to achieving about uh, almost 40% of the goal. And this goal is obviously till 2045. Largely his investment has been into equity. He's a long-term investor with us, with very small allocation to gold. This is investment holding, what obviously we don't want to. So obviously there are certain funds like TIW and other dollar investment options, some mutual funds, some equity. So we are just trying to share few of the holdings. So what we are trying to reiterate is, end of the day, whatever your investments are, if you link it to your goal, actually our software will, or our website will actually help you, guide you that how far you are from achieving your goal. See, everyone wants to actually retire early and be financially independent, right? But we don't know how much we need to save, right? Or we need to invest to save, to retire by specific age. But if you have a target in mind that I want to retire by age of 55 or 60, or even early by 50, and I want to just live on my own. So then we that's where our job comes in, to help you plan your retirement goal, help you ensure that how you achieve, and we continuously monitor. This is something which you can track it on a regular basis, and we obviously are there to guide you and take you through this entire journey and ensure that you achieve your retirement uh, goal, or any other financial goals what you have. Obviously, as a investment advisor, as a financial planner, wealth manager, we have various investment strategies what we follow depending upon clients' time period, investment horizon. Growth strategy is largely meant for long-term capital appreciation, a portfolio of equity and equity-related instruments. Sorry, we have a moderate strategy, which is basically equity, largely equity, 70% equity with some allocation to debt and gold. Asset allocation is which continuously rebalances between equity, bond, and gold depending upon the prices and the valuations of the market. And then we are obviously two conservative and defensive strategy meant for investor who are conservative, who doesn't want any risk on their capital. They're happy with stable return. Your equity exposure as low as 30% and 10%. So they're really safe investment strategy with uh, very low exposure to equity. This is in terms of performance, obviously, just to trying to highlight what has been our performance over, and this all returns are more than 1 year, are CAGR. So these are compounded returns for annually compounded returns for 1 year, 3 year, 5 year, 10 year. and this is in terms of what services what we offer from our side. Without wasting much time, now I would like to introduce Mohit. Uh, so I will end my presentation here. That's my team, obviously. Pranav is there with us on a call. Neil, Pranav actually heads the product side of it. Myself, obviously, Pradeep. I'm the founder and the CEO. Looking at the business side of it. Pranav looks after the product. Neil looks at the marketing side of it. He's our chief marketing officer. Uh, this is in terms of our presence. We'll share the details again later. Let me quickly introduce Mohit, who's with us on a call. Just hi Mohit, you're there?
Yeah, hi Prateek.
Yeah, hi Mohit. So Mohit, we have a wonderful speaker, Mr. Mohit Ralan, who's a managing partner and the CIO for TIW Private Equity. He brings in a rich experience of more than 2 decades, where he specializes in buyout strategies, and especially how he's been able to actually do well in times where the growth has not been there, by expanding margins of the companies in low growth environment. And he's been a specialist. He's worked with bearings companies like bearings, Tata Group, and in various sectors like FMCG, technology, real estate, and he specializes in buyout strategy. It's one of its kind as a strategy in India. We don't have any other buyout strategy fund, to be honest, in India. Globally, yes, there are few which Mohit will share. So without further ado, Mohit, over to you.
Thanks a ton, Prateek.
Money, you will have to just share the give him the sharing right for presentation.
Yeah, I made you a host, Mohit, so you can share your screen.
Okay, yeah, thank you. So just let me share my screen. Is it visible?
Pratik, you might want to switch off the screen sharing
Yeah,
option.
yeah.
Is
I've
it
just done
fine?
it. Yeah, yeah. No, one sec, Mohit. You'll have to do it again.
Yeah, no worries. Okay, I think I need the host rights to do it.
I made you the host, Mohit. Go ahead.
Screen sharing has failed to start. It's saying that.
Okay, I can help you in that respect. Hold on one second. I can share my screen and oh no, wait a minute.
Just give me a minute. I'll try again.
Yeah, you'll have to do it because you're the host right now.
Let me do something. I'll pass the host rights to you. You can pass it back to me quickly. Let's see if it works. Because I think simultaneously I had put in and Prateek had removed. Can you make me the host again? Let me just try that.
There you go. And while we are at it, I just want to let the attendees know that if you have any questions at all, feel free to type in the Q&A box, or if you want to come on mic and ask a question yourself, feel free to raise your hand, and we'll give you the option to do that after Mohit is done with the presentation. So I'm hoping that all of you have your questions ready. Cool. Mohit, you have everything ready?
Yeah, the problem is I think when I had put in, now I don't think so mine is working.
Okay, do
The
you want to
screen
go ahead?
share.
I'll try to share it from my side. So
Yeah, of course I'll do that right there.
okay, cool.
Okay, I've made you the host and shall I start?
Yeah.
You can make it full screen. Okay, while Mani just sets it. So I'm not going to take more than 17, 18 minutes. I'm going to keep it very simple. But the idea today is obviously to talk through a particular style of investing buyout. I'll keep it very simple and importantly, factually based. So let me just set the context in my background, and apart from the introduction that Mani and Prateek gave. So basically, I have served multiple boards over 4 recessions, 2 decades, 5 funds. Cumulatively, in funds I have been with, we have paid around $1.5 billion back to investors. And I've seen some 375 plus board meetings now. My team put together, we have around 800 plus. And if you have to ask me one line resume, then I think the most important point I have to say is that across time frame, we have never ever lost a penny for any investor. So that's where I think the key important point is to start with. So today I'm going to talk about investment options for returning NRIs specifically, and even NRIs at large in general. So moving to the next slide, what are the investment objectives? What is the strategy, and how should be the portfolio design? So in general, forget stock markets or debt investments, equity investments, cash, real estate, structured notes, private equity, venture capital. What exactly is needed in any investment portfolio? Let me spend a minute on it. The first and foremost important factor is currency. In spite of the best of returns in a lot of countries, what we have realized over 2 decades that the underlying currency risk tends to be a big risk. Imagine you investing in Venezuela and currency, the currency crashes like anything. So in spite of the value of the underlying asset going up in the local currency, the returns will actually be, significantly negative. So investment options that are dollar protected is my first point. My second point is the investment should obviously lead to capital multiplication. You're not looking at something which is going to give you 3-4% compounded. Now, a lot of times investors and prospective investors have asked me as to what exactly should be my goal. We all have the goals in terms of looking at retirement planning, sending our kids abroad, higher education, buying properties, having a decent life, quality of living. But what's a good compounding? Is it 5% per annum in dollar terms? Is it 10% per annum in dollar terms? To me, I think the simple answer is family inflation. Each one of us have a different family inflation. The inflation of a country is not necessarily correlated to the family inflation of the individual. If I go abroad twice a year for leisure, and if I am planning to send my kids abroad, or if I plan to look at buying multiple properties abroad, my family inflation is going to be very different than inflation at large. So it's extremely important for you to understand the concept of family inflation. Very, very rarely, wealth managers and even fund managers talk about family inflation. So capital multiplication to me should beat family inflation. Apart from that, regular income plan and liquidity. All of us love to see the concept of rental yield and capital gain. Why do we like properties? There is a physical asset that we see. There is a rental yield that accrues. I keep getting monthly income. And then on top of it, we get capital gain. So that's called liquidity and regular income. Then the most important point is safety of principal. Safety of principal is an extremely important point. Irrespective of quantum of returns, one should not lose principal. And that's a very, very important element of any investment strategy. The fifth element I'll say is diversification. I think Prateek very rightly pointed out multiple ways of diversifying. But all eggs in one basket is always a bad idea. So diversification is an important goal, and there ought to be an optimum holding period. Now, let me give you an example. Medical, for example, in India, it takes 4.5 odd years. Engineering takes 4 years. When we go and look at investment, we want returns in 6 months. Whereas when we want to get educated, it typically takes 4-5 years. So the point I'm trying to drive is every investment has an optimum holding period. So capital protected with good liquidity, principal never should be lost. Diversified portfolio with an optimum holding period is a recipe of a fantastic wealth creation. Let's move forward. I've taken more time on my first slide, but I really wanted to set the context right. So let's move forward to the next slide. What about geography of a portfolio? So let's look at something very interesting in the next slide now, how the geographies work and how economies at large globally work. Very simple slide, but what I really want to bring out emerging markets, while they give high growth, developed markets give higher stability. So, of course, while you allocate your portfolio to developed markets, you ought to also look at high growth. So some part of the portfolio ought to go in fast moving markets and high growth markets so that your family inflation can be beaten in terms of returns. A case study or an example in this is India, being the third largest economy by 2030 as projections by majority of economic houses. Currently, it is contributing 5 to 7% of incremental world GDP, and this is expected to become 12 to 13% of the world GDP. So the point I'm really trying to drive is what's going to drive the next level of growth? Which are the countries that are going to give you higher growth, and which countries will continue to give you stability? So the portfolio, perhaps 75-80% of your portfolio should go into, if you're staying abroad, and if you're staying in developed countries, it ought to be 75-80% in developed countries, but it ought to have also 20-25% element of high growth markets. Let's move forward. So this, having spoken about India now, let me give you very simple parameters. Prateek's very well and aptly articulated the depth of Indian market, the returns. Even I actually noted few slides because he spoke about the timing part, the percentage of times returns have been positive. But there is something more fundamental I really want to drive today. Consumption baskets in last 60 years. This is a very interesting point. Not China, but consumption baskets. So United States of America, baby boomers from 1960s, Margaret Thatcher days, UK, Japan in 1980s, and Germany after World War II. There is one correlation coefficient. Correlation is almost 99%, and that is to the average age of the country. I'm not talking demographic dividend. The average age of a country, all these countries was late 20s to early 30s in 1960, Margaret Thatcher days, Japan, and Germany after World War II. India's average age is 27 years. Whenever that happens, and the per capita income crosses $2,000, the discretionary spend tends to explode. This is exactly what happened in the late 60s in Japan, Korea in 1985, and China 2006. And India is exactly at the same inflection point. What's happening, interestingly, is A, because of COVID, and B, because of the last 15 years, technology has allowed countries like India specifically to take a steeper curve in growth. Somebody asked me, what have been the drivers of wealth creation globally in the last few centuries? Forget last few decades. The first and foremost, if you recollect, was Renaissance, Industrial Revolution. Western countries gained extremely well during Renaissance. But what is the Renaissance of 21st century? The Renaissance of 21st century is technology. I don't think so. I mean, among all of us, there'll be any debate about it. And inflection points like COVID actually leads to a higher manifestation of technology-driven solutions. And India and Indians are leading in that. Look at the number of CEOs, CXOs, and seniors across the world, right from service companies to product companies, B2B businesses to B2C businesses. Let's move forward now. Having set the context of per capita income and consumption, there is something very interesting I want to bring out. This is actually one of my favorite slides. Regional disparity of growth. At TIW, we have investors from 21 countries. In my previous funds, institutional investors, let me tell you which all countries and what kind of institutional investors invested with us. And one of the reasons is this slide. And let me explain that to you. We had Calipers, California State Pension Fund. We had Columbia Endowment, AT&T Pension, General Electric Pension in United States, Government of UK CDC from UK, Government of Netherlands FMO. In Middle East, we had Government of UAE Abu Dhabi Investment Authority, Qatar Investment Authority from Qatar. In Southeast Asia, we had United Overseas Bank and Government of Singapore GIC. And China, Hong Kong, we had Asia Alternative. One of the things which has worked very well for us, and I want to put it across because all of you are HNIs and non-institutional investors, so to say, is regional disparity of growth. How many fund managers bring this out? Eastern Europe versus Western Europe. In all 21 countries, when I ask my investors, do you like investing with the United States of America? Unanimous answer, timing aside, in general, yes. But will you go and invest in all 50 states of United States of America? Almost a unanimous answer, no. Not every state creates the same opportunity. But when you look at large markets like India, how many of us are looking at regional disparity of growth? South India, I call it south of Vindhyas. Take the map of India. Vindhyas is a mountain range in the center. South of Vindhyas, essentially 7 states out of 30 odd states of India: Gujarat, Maharashtra, Andhra Pradesh, Telangana, Karnataka, the hub is Bangalore, and Tamil Nadu and Kerala. These 7 states of India contribute almost $1 trillion in GDP. The GDP growth rate in real terms is 9.5 to 10%. This is the fastest growing region in the world at $1 trillion scale. The GDP is higher than GDP of Saudi Arabia, higher than GDP of United Arab Emirates, Switzerland, Singapore, Hong Kong, and it will overtake Netherlands in 2 years. For last 1500 years, forget politics, that's democracy, geopolitical stability. For last 1500 years, there haven't been any large wars. All 3 sides is water. The per capita income is 50% higher. There have been 3 areas of wealth creation in India in the last few decades. First is ITS hubs. If you look at it in this chart, 90% of ITS hubs are in south of Vindhyas. Hyderabad, Bangalore, Pune, Mumbai, Chennai, Trivandrum, Coimbatore, all of them. And second area of wealth creation has been money transfer. US, Hyderabad, Bangalore. Middle East, Kerala. Southeast Asia, Tamil Nadu. So if you look at contextually, and the third area of wealth creation,
Mohit, I think your feed is stuck, as I can see here.
Yeah, Mohit, Azhar probably is.
Okay, Mohit, I think we lost you there, and you're muted right now.
sorry about that, the internet flipped. So is it fine now?
Yes.
Yeah, that's fine.
Go ahead.
Yeah.
Okay. So basically, the third area I was mentioning is commodity herbs, cash crops, and mining, all of them again in South India. So what I'm really pitching today is south of Vindhyas, which is growing extremely well with geopolitical stability and global linkage. Pharma and technology, the 2 hubs where India has done extremely well, which Prateek as well pointed out, it's majorly in south of Vindhyas. Next slide. Having explained about the geography focus, having explained about what should exactly be the underlying aspects of a portfolio, let's look at asset selection. This is another interesting slide I really want to speak today. The buckets of wealth creation. There have been primarily 3 ways wealth has been created in the last few centuries. The first and foremost is running your own business. The second is professionals like doctors, lawyers, chartered financial analysts, chartered accountants, and the likes. And the third has been CXOs, senior managers and CXOs in mid-size and large companies. Interestingly, one of the research says that 95% of the time, people spend on creating wealth. Just look at the benchmark, do a dip test, close your eyes and think about it for 60 seconds. What percentage of time you spend on creating wealth and what percentage of time you spend on preserving and growing wealth? The global benchmark is just 5% of the time is spent on on growing wealth and preserving wealth. How has wealth been grown and preserved in the last few centuries? First and foremost is physical assets, real estate and gold. For last few centuries, it's done extremely well. In the last few decades, listed market. So I'm sure Prateek pointed about simple products like shares, buying shares of Apple to Google to any other company, and to complicated products like structured notes. So obviously mutual funds, exchange traded funds, everything, portfolio management services and the likes, all of that is a spread, but spread on a listed market. But there is a third bucket of investment, which is 8 to 10%, 6% with HNIs and retail portfolios, and 8 to 10% with pension funds. Pension money is supposed to be the safest money, right? 8 to 10% with pension funds and even sovereign funds, and that's called a buyout fund. What exactly is a buyout fund? A buyout fund goes and takes controlling stakes in companies. So my favorite example is when you buy a property, I'm sure most of you and each one of you would have bought properties. You don't go and buy a kitchen or a living room or a bedroom. You go and buy an entire house. Sounds ridiculous, right? But when we go and buy shares, we go and buy 5, 10, 15, 20 shares. A buyout fund goes and buys entire house rather than buying kitchens, living room, and bedroom. Blackstone, Carlyle, TPG, KKR, Bain, and the likes. These are some of the largest buyout funds in the world. Berkshire Hathaway, one of the biggest strategies, has been control position, Warren Buffett's company, right? And 8 of the top 10 largest funds are buyouts, right? And today, I, representing the buyout space, having seen 4 recessions, 5 funds, we have delivered 15% dollar compounded return to investors over last 2 decades in all funds I have been with 21 countries investors. I'm going to talk in the next 7-8 minutes about buyout funds. This is the last leg of my presentation. So a typical portfolio allocation of HNI, you would normally see around 30% equity, around 25% cash, 17% fixed income. And as I said, with HNIs, it's typically 6%, 6-7% buyouts. And with institutions, it's around 8 to 10% buyout funds. Of course, real estate is 15%. Of late, investors have started doing angel investing. So VCP portfolio allocations is also there. But let's look forward that what is the risk profile of a buyout fund? Remember the first slide where I spoke about liquidity and various elements. So in the next slide, let's now focus about the risk profile of buyout funds. So a buyout fund, the asset class which has displayed superior returns than any other asset class across geographies and time frames with far less risk. So let's look at some charts to look at these aspects. So the first and foremost point before I take you to data is, what do buyout funds do? Buyout funds go and buy private companies majorly. They even buy listed companies, frankly, especially the large funds. But the key tenet is taking controlling stake. So it's a shareholding control and board control. Forget whether decisions are right or wrong. The fact that a buyout fund is in a position to drive change management is extremely important. In all companies I have, I've been in the funds with, where we invested in 60 plus companies, we had 100,000 employees. The biggest change we bring to table is ability to create managerial depth. Extremely low linkage to stock markets. If you already have a good portfolio and you have Prateek and people like him who can create those portfolios, an important asset diversification is non-linkage to stock markets. Interestingly, hardly 1.5% companies globally, or even less than that, are listed, but majorly 90% plus products in the market in the global context are linked to listed market. It's a great dichotomy. It's a paradox. 99% companies are unlisted, whereas hardly 1% companies are listed, whereas 90% products are linked to listed markets. Let's look at next slide. How buyouts have historically generated best of returns is because of these points. So this is the chart I really want to bring out. Almost every fund and fund manager delivers great returns in good markets. I repeat, almost every fund and fund manager delivers great returns in good markets. However, here is a style of investing: $3 trillion. $3 trillion is the quantum of money which has gone into this category. Majorly, it was not available to HNIs historically, especially even in the Indian context, because it was primarily institutions who could have done it. But the government has made a lot of changes in the last 3-4 years, which has started allowing funds like us to take HNI money or non-institutional money. Let's look at, this is Cambridge Associates data. Let's look at how buyout funds have done in bad markets. So when you look at the great 3 disruptions of last 30 years prior to COVID-19, Gulf War in 1991, dot-com burst of 2000, and subprime crisis of 2008. What's interesting to see, across all disruptions, the green bar, buyout funds ended up delivering far superior alpha return than listed market. I've just taken S&P 500 as an example. You can pick any other benchmark. Why does it happen? Because stock markets lead the economic recovery. Economic recovery is still to happen. A lot of people are talking about great recovery in this coming calendar year. However, underlying ground reality for a lot of companies still different, and this gives an opportunity for buyout funds to buy companies at a cheaper price. And that's why this is the best time to look at funds like these, because stock markets have already exploded to a level and buyout funds are still able to buy companies at a cheaper price. Last week, we have just bought a company where Unilever Ventures is invested. We have taken controlling stake. Unilever is a continuing party. As an investor, and Prateek mentioned about FMCG and consumer. This is a consumer company. This company is owned by Mahesh Bhupati, who's a world Grand Slam winner multiple times. And this company owns brand rights of celebrities as joint ventures. So this company as of today owns right of Virat Kohli. It owns rights of Salman Khan. It owns rights of Lara Datta, and there are more in pipeline. Companies going extremely fast in the FMCG space, like deodorants, obviously perfumery, deodorants, bath and body, skincare, color cosmetics, and the like segment, which is doing extremely well. And we have just taken recently controlling stake in this company. Next slide. Having explained about, the returns have been fantastic in bad markets. Why do buyouts generate significant alpha? My last 3-4 slides and last 4-5 minutes. Why do buyouts create significant alpha? Because buyouts are able to get relatively low entry valuation, especially in bad markets, and especially in times when markets are high, but ground reality and underlying recovery is still to happen. And control position always allows you to drive higher change management, leading to higher margin expansion. One can proactively take decisions, and it's the own expertise which matters and not the stock market which matters in this case. Buyout funds primarily drive returns to margin expansion. Prateek spoke extensively about growth and fantastically explained that. Let's look at the margin expansion way. Companies grow means top line grows, but when margins improve, the bottom line grows. So next slide, let's look at a simple example of, I'll skip this. Let's go to the next one, please. Money. The next slide. So let's look at the next slide, and I'll give you a mathematical example. So I'll skip the slide. Yeah, thank you. So quickly, the mathematical example. Sorry, Mani, I think the slide just went one ahead. If you can just take it back, please. Reverse. Yeah. Thank you. So this is a very simple mathematical example of how margin expansion and buyouts work. So let's say a standard growth fund. When a sector is at 15% margin, I'm not saying a company. Let's say a sector is at 15% margin. Obviously, it's an average of companies above 15 and below 15. Not every company does well in every sector, right? So a standard growth fund will go and buy companies above 15, which means to have a 20% bottom line compounding, the top line will have to more or less grow at 20%. That's called growth investing. A margin expansion investing of a buyout fund, exactly like a Bain Capital or a McKinsey works, we go and buy a company which is relatively lower at the margin profile. Let's say we go and buy a company which is at 7% margin. Through our operating interventions, even if we take up by 1%, this is 14% return for my investor. Average of 15%, we will have a 2x return with 0% growth. And this style of investing I call as the margin expansion way of doing it, or the Warren Buffett way of doing it. Now, with this, I just want to summarize with 1 or 2 slides about TIW. So next slide, Mani, if you can help me with that. So about TIW, TIW is a buyout fund in India, and now it is accessible to HNIs. The overseas investors don't have to invest directly in India. You don't need a PAN card in India. That's the change the government of India has made in 2016 Financial Act. 100% repatriation of dollar money is allowed. We have been taking investors' money for 2 decades through the Mauritius route. Mauritius follows UK law because it is a Commonwealth. And importantly, it's a dollarized product. There is no risk of depreciation because whatever depreciation of currency happens, that is adjusted against our share of profits. Now, this is a very important point. Getting exposure to an emerging market with a dollarized product, not losing money on currency and getting exposure to emerging market. That's what TIW essentially does. And that's the reason a lot of investors and multi-ethnicity investors like to invest basically into fund like ours. Moving forward, a little bit background about the team. So I'm the managing partner and chief investment officer. My own family office has invested few $1 million into my funds as sponsor. I have been awarded as the most promising business leader of Asia for 2 consecutive years by Times Group. And apart from me on the advisory council, we have Mr. Satyamurthy is working with the European Union, and he's ex-Comptroller Auditor General of India, and he's also the first honorary CEO of India's Anti-Corruption Academy, Dr. Ravi Bastia, founder of Reliance Industries Oil and Gas. I'm sure all of you, Bastia did the largest discovery of South Asia. He's also done the largest discovery of Oman. Till recently, he was chairman of Masira Oil. Kamlesh Gandhi, a veteran on holding companies of Sundaram Group, a very respected group, as board of directors. Dr. Reddy's lab for 15 years from 1987 to 2002, Kirloskar and the likes. 320 capital issues and IPOs he has done in India in the last 4 decades. That's the highest anybody has done, literally selling one company every 45 days. And Mr. Vijay Kishore Sharma is based out of London. He's on our Mauritius board. He was head of Greenless Bank in 90s. My last slide, I just want to go to. The fund strategy is very simple, low risk, dollar investment, no leverage, and 1.8 to 2 times return in dollar terms. Over 2 decades, 5 funds, 4 recessions, 15% dollar compounding back to investors, no PAN card needed, no direct tax risk for investors in India. So I thought I'll just position buyouts because Prateek spoken well about the listed side. So I thought I'll talk about the unlisted and the underlying risk being far lower in this strategy. So thanks for the time and thanks everyone to be on call today. Money back to you for any questions and clarifications.
Thank you, Mohit. That was good. If you want to take 5 more minutes, that's fine. I mean, I know that you have a few more slides ahead, so I don't know if you want to go through those. That's fine.
Okay, so I'll just take then everyone through this. Actually, this is one slide which we normally show, and when we do, all of our investors and even prospective people, we look, like to show them what happens when market conditions are bad. So what happens to buyout fund returns in bad markets? That's what I'm really trying to point out. So typically in our investment strategy, we have both fixed income returns in dollar terms and equity returns. Prateek spoke about a balanced approach, both fixed income returns and equity returns. After investing on a quarterly basis, typically we give 1.5 to 2% returns in dollar terms every quarter. It's like a rental yield equivalent. So investors get 6 to 8% returns in dollar terms. And on top of it, if market conditions are bad, while our guidance is 10% on the equity in dollar terms, this can reduce to 5-6%. But even in a bad market, investors worst case get 12-13% dollar compounding. If the risk is low, no negative returns, fixed income, keep getting quarterly income plan, quarterly liquidity, and a 12-13% compound in dollar terms. More importantly, for returning NRIs, if you have invested in dollar terms and you get into India, while your tax status changes, this investment, because of 100% repatriability of dollar money, can straight away get transferred from your international dollar account to India account. Obviously, taxation will change because your tax residency will change, but earlier it was not allowed. In the last few years of changes that the government has made, even if you shift back to India, the investment does not get impacted. And that's the beauty. And that's the key message I really wanted to give today. So Mani, I think that's, I guess, the last slide. You can just.
Yes, I think this is.
So this is just a summary.
Yes.
That the buyout style provides capital multiplication, liquidity, diversification, lower risk, the principal protected environment.
Got it. Great. And then you have the contact address here. So I'm just going to leave this here.
Yeah, absolutely.
Anyone would like to contact. So yeah, brilliant, Mohit. Thanks a lot. And right on time. Appreciate that. Thanks both of you, Prateek as well. We do have some questions. So I'm just going to pick up or read out the ones that we have in the Q&A box. And then if you either of you want to address, feel free.
Mani, if you don't mind, if you can just share my last slide for contact details and information.
Sure.
So probably, that can be one which will be a common across where we can address the
Is
queries.
it this one?
And yeah.
I don't think there is the contact.
No, just move it. Just go up. No, these are the annexures actually. Just go down. Still below.
That's the last one.
No, just then go up. Go up. Little up. You'll have to go a little ahead. Few more slides. Yeah. Few
it's
more.
The contact, right? Yes.
Yeah, contact. Just ahead of you.
This one, right?
The one before. Just one before. Yeah.
Okay, cool. Awesome. So let's just go to the Q&As.
Yeah.
So the first question is, with the work from home situation to continue for longer duration may even become a norm. In such cases, does investing in commercial real estate for rental income make sense in cities like Pune? Who would want to answer that? Mohit, do you want to?
Yeah, sure. So, my view, so we have done investments over 5 years. We have given 36% compounded in real estate, by the way, back to investors. However, we have a strong view that with the COVID kind of environment and work from home happening, residential real estate is going to do very, very well. I'm right now like talking from home because it's late evening. So we need extra study room right now, given that maybe both husband and wife who are working, they need space and more space. So what we are seeing, residential demand has gone up, and the rental yields, even in cities like Hyderabad, by the way, just to put it across, it is rank 1 in the global momentum index of JLL, above Dubai and Shanghai, with good rental yields, good capital appreciation, especially on the residential side. So I am honestly bearish on commercial, but I'm extremely bullish on residential because work from home means demand for more properties, and COVID crisis has taught one thing: people now prefer buying houses rather than staying in rented apartment.
Got it.
I'm sure if you track US data, you'll see people moving out of even apartments and moving to independent houses.
Pratik, you wanted to say
In fact, yeah, just to add that, completely agree what Mohit is saying, in terms of demand for residential houses have gone up. And specific question to what gentleman has asked in terms of commercial real estate, we feel commercial real estate will take some time to, pick up, because if you look at not only, globally, India as well, today work from home has become a norm, and that's going to be the way ahead. I've seen a lot of larger corporates have told the employees that, we are giving up the office space. We might not need it, So people will be given an option, hybrid option or probably option for work from home. They might not be looked to, come back to office if it never required, So I think that entire cycle around commercial real estate is still very dicey, and to us, we feel there's a lot of supply also. So I always feel that supply demand is very important. So I feel, especially in cities like Pune, Mumbai, the supply has gone up, So we are yet to see demand pick up. So I wouldn't suggest someone to look for an investment point of view, real estate for a rental yield, because yields will be very low, and post tax, post expenses yield can be less than bank FD, actually.
yeah.
So you are much better off putting money somewhere else, rather than real estate, commercial real estate.
Cool. Awesome. Next question is from Rahul to, I believe, Mohit. The question is, Mohit, you mentioned US residents should invest around 70% of their money in developed economies. What should be the ratio of investment in developed versus emerging for Indian residents?
Okay, so I think I've just written an article in one of the magazines the day before on investing for Indian residents outside India. So there, our recommendation is 10 to 15% allocation into global, dollar assets, purely for two reasons. One is the actual depreciation of Indian currency from 1998. I have been in this business, so till now, 22 years is 4.2 to 4.3% annualized. And that's the difference between interest rate differential of US market and Indian market. So it's extremely important if people want to send their kids abroad, because in emerging markets, a lot of them do that. And a lot of people even settle abroad eventually to create global dollar assets. And hence our recommendation is at least 15%, money going into global dollar assets.
Got it. And another question is there any key difference between a buyout fund and an SPAC?
Oh, absolutely. SPAC is absolutely nothing but it's a clean company which is used to acquire, raise money through an IPO route, primarily to acquire companies, or it's just a company to acquire companies. Now, a buyout fund is an active fund. It's not just a passive. We also bring along with us extreme expertise. Let me give you perspective. The head of Infosys, BPM, for US is on my panel. The ex-head of HR, Dean of PepsiCo University for Asia, Africa, Middle East is on our panel. The ex-head of fixed income Stanchart Asia is on my panel. These are the kind of people who get seconded into companies on project basis to start driving change management. The two things we bring to table as buyouts globally is one is improving labor productivity and second is automation side of technology. Lots been spoken about the product side of technology, but what about automation? Look at healthcare operations. Look at the automation side of technology has made a key difference to the world, and that is what we bring to table to improve cost efficiencies and leadership. So SPAC is more of a passive thing to raise money to acquire an underlying asset, whereas buyouts, we actually go and do active capital management.
Got it. Sudhir is asking, can you touch base on the minimum required to start in your funds as well as fees? Is there any particular lock-in period?
Yeah, so the minimum is $250,000 if you do a dollar investment, but in special cases, we do reduce it to $125,000 where we need a board approval. But then special cases, if there are two friends who come together, they don't have to invest together. They're separate accounts, but then we go to the administrator and take an approval. So $125,000, it is not to be paid together. It is paid over 12 months in equal tranches of 25%. So $125,000 equal tranches of 25%. Which is $31,250 roughly into 4 tranches. And importantly, it's a standard 220 model where 2% fees charged globally for all buyout funds. It's a shorter tenor. After drawdown, within 4 years, we exit completely. More importantly, you don't have to wait for returns. We give quarterly returns back like a rental yield. So from Jan 22 onwards, the current fund, and we keep doing funds every year basically. You'll start getting 1.5 to 2% quarterly, and in the end, additionally, a 10% odd compounded in equity. However, transfers are allowed, even though redemptions are not allowed. On the lock-in part, we charge 0% exit load on transfers. Typically, we have seen it happening in 90 to 120 days.
Nice. And can INR be invested in TWBI?
So yes, INR can be. Yeah, Pratik, you can just take that.
INR also investments can be taken in TIW. So there, the minimum investment is obviously it qualifies as an AIF fund. So its minimum is 1 CR, so 1 crore, which is about 10 million rupees, or 1 CR in terms of INR. And yes, again, same, the concept remains same, 25% investment over 4 tranches over 18-month period. Obviously, the fund is already ongoing right now, so they've done their first round of raising in terms of capital. So first 2 tranches will be closer from as an initial investment, but then it's by December next year is when, or January next year is when they close the fund for in terms of collecting the funds.
And I just want to mention additionally that we are fully subscribed. Whenever we launch funds, I say with a lot of pride and humility, we are able to raise within 6 months. And we just started 4 or 5 months back, and we are completely subscribed into green shoe, which means oversubscription. And few months we'll just shut it completely. After a month, we'll start charging premium because NAV goes up. As I mentioned, we have just bought 2 companies. We have also sold a company recently. Tatas have bought a company from us. We have sold one to Hewlett Packard worldwide in the past at Bearings, by the way. Emphasis was our company. If any of you have heard of Emphasis, we sold it to Hewlett Packard in the past. Muthoot, that was our investment. We got it listed. Manappuram, Radio Mirchi, that's Times Group. A lot of these companies. Marico, $100 million we invested along with, government of Singapore. Just that in the last 3-4 years, as I said, government started allowing HNIs to invest into our kind of funds. Earlier, we couldn't have taken that money. So, and ref checks, you want a client in US, you want a client in Australia, you want to get a ref check in Qatar, UAE, Kenya, Africa, Southeast Asia. Tell me a country you want a client reference. Majority of our investors, we get through client references, basically.
Cool. And what is the eligibility requirement to invest in buyout funds? This is Rahul asking the question.
So that's what government has changed. Historically used to be very high, million odd, but now, as Pratik pointed out, for Indian investor, you can do it through NRO accounts as well, by the way. If you're a NRI, you can even do through NRO, which is 1 CR in 4 tranches. And for international investors, why standard is $250,000. But as a special approval, as I said, we can reduce it to $125,000. There are few. By the way, I also want to mention. Yeah, go ahead, please, Pratik.
No, please, no, carry on.
So, important point, we also do US SEC filings. I have investors from 12 states of United States of America invested with us. We do US SEC filings. We are not registered with US SEC because it's offshore. We do filings with US SEC. So there are some minimum benchmarks in terms of some countries we can't take money. The standard one, which US doesn't like, let me put it bluntly, those are the countries we don't take money from.
Okay. Sudhir is asking, do you issue 1099 DIV for the
So
returns?
I meant if you're from a particular country, which is issue K1 annually.
Okay. Mohit, your voice sometimes is getting a little bit laggy. So
Yeah. I was just
So
about
let
to say
me
that.
move out of video then, if it's just okay.
That's fine. That's fine. Cool.
So I'm saying, so we issue form K1. We have our lawyers, tax experts in US as well, in New York. So we issue form K1 essentially.
Okay. Cool. Rahul is asking, is there a minimum for buyout investment? Also, can you share details on tracking tools that you'll provide with such an investment?
Sure. So I think very importantly, I've mentioned the minimums, but this is something where we take a lot of pride, for everyone's benefit. We have our own in-house platform where investors within 15 days of investing will get access as a user ID password. This platform, essentially every detail, right from your fund dockets to statement of account to portfolio company details, to the extent we declare quarterly audited financials of private companies with management declarations available at a click of a button to you anywhere in the world 24/7. This is not mandatory even in US. We follow European venture capital norms. They're the most stringent in the world. And that's why we have Emiratis, Qataris, and the likes who have invested, multi-ethnicity. So those are the things you will get as access to that tool. And the investment also for NRIs, I want to mention this point, while it's not us, it's very important. It is through digital route, no physical meeting. We send you a form with simple passport and a simple address proof and KYC. Our team, and the backend fills it, sends it to you through e-basis. You sign it digitally. It goes straight away to the administrator. Our administrator is Apex as the custodian. They manage $1 trillion globally. They also manage funds like Carlyle Asia and all. And they essentially then, once they approve it, you just get a wire transfer request. If you're getting money in a particular account, you're sending, from a particular account, and you yourself have another account, let's say in Dubai or Guernsey or India or anywhere else, you can get even money in some other account. You can give us KYC within 6-7 business days. Money can come from one account, go into another account. In the sense, if you change your country, tax residency, all those are absolutely okay. You can invest through BVIs, LLCs. I have investors in US who have done through LLCs. You can do through tax jurisdictions like Guernsey or Geneva Trust account, individuals, partnerships, everything is fine.
Cool. Rahul is asking, will the slides be shared? Yes, you'll get an email if you are registered with the slides. So that's taken care of. Are there different segments within buyout funds? Quickly, Mohit.
Okay, yes. So there are some funds, especially in US, that are leverage buyout funds because the cost of debt, like Prateek pointed out, has been dropping globally. So they take leverage, but not necessarily every fund is a leverage buyout. TIW is a deleverage buyout fund. What does it mean? When we invest in emerging markets, second rule of Warren Buffett is zero debt. We don't believe in debt. Across all 4 market crashes, we have done extremely well because none of our underlying investments have debt. And this philosophy has worked extremely well. So we are a deleveraged buyout fund. Typically in Western context, because cost of debt is lower, as I said, it's leverage buyout. We actually go and remove debt in companies and take first charge of assets. Like a bank, when you take a home loan, they will ask for collateral mortgage, right? So when we go and invest into companies, remove bank debt, take charge of assets so that there's a downside protection. Under no circumstance, principal should be lost. So we are a DBO, deleveraged buyout fund.
Okay. Rakesh is asking, is the 6 to 8% return in dollar terms guaranteed in buyout fund, and in addition to any gains are paid out?
Okay, so let me answer that. Typically, when we invest in companies, a little technical, but to answer that is important. We invest as optionally convertible debentures under the Indian Income Tax Act. The minimum rate for the optionally convertible debentures is the State Bank of India's reference rate under Indian Income Tax Act. The SBI's reference rate tends to be 7% plus typically, and hence, to give you perspective, if the company doesn't pay that or doesn't or let's say if they make it 0, then the return will get disqualified. So that's how we ensure that 6 to 8% is guaranteed for our investors. However, there can be quarterly swings. As I said, it can be 1.5 in a quarter to 2%. The only comfort I can give you, in all our funds, even in 2020 market crash, when the world crashed in March of 2020, we paid a 2% in dollar back to investors. And that is the kind of stability of the returns. On the upsides, yes, 10% plus is the guidance we give compounded per annum on equity. So if you, that comes in the end, which is 4 years after drawdown. If you add the two, you're talking 16% dollar, 20 years track record of 15% plus compounding. However, worst case, if you have to put a gun on my head, if we are exiting in a bad market, it will be 12% odd dollar compounded return, because 6 to 8 will still come. The only thing will happen, the equity return can dip from 10 to 5. I've taken a 50% compounded dip. Please note, in the March of 2020, when the world crashed, it was a 45% dip. I'm sure Prateek will agree 50 is a massive dip. So even then, it's like a, it's like a, I think he nicely said, when 50% dip happens, the growth has to be 2x. So so worst case scenario will be double digit in dollar. You can record this.
Cool. Arvindan is asking, where do we find the details of the fund facts, as in fact sheet, as the details discussed?
So I'll ask Prateek to, I'll ask Prateek to, maybe if, Mani, the contact details is mentioned for Prateek. He's been a strong associate for so many years, and like dozens of his investors globally have invested with us. So he has all the fund details and fact details which can be shared, I'm sure. And if there are more queries, I'm always happy to get on call. We have a strong team of 20 people.
So if you guys
we can share all the fund fact sheets. We can share all the fund fact sheet details, whatever required in terms of details per se investment, prior investments also in the various funds. We can share all the company details as well. In fact, we can share all that.
Cool. Yeah. And also, I was just saying that if any of you would want to get more details on how to get started, feel free to contact them on the contact details mentioned on the screen right now. This whole video will be shared on YouTube as well. So if you want to refer it later point, feel free to do that. But we'll move to the next question, which is from Rakesh. He's asking, if I have to invest in TIW, how do I go about it? Any document we can refer to go over the details? I think we've covered that, but just quickly, Mohit or Prateek.
Yeah, I mean, very simple. We can send you the idea was today talk about buyouts, but we can send a fund presentation extremely detailed with track record as well. And after that, once you decide, the form filling is very simple, digitally driven. Our operations team will do it. And then through Prateek's team, we send it to you. You sign it digitally. It electronically goes to the fund administrator. If they have any queries, they send it back to you for new documents. If not, then they will just send you a wire transfer request. You transfer electronically, basically. And then you get all the details. These are shares that you subscribe in the Mauritius fund. Just want to tell you, we have paid back $1.5 billion to investors globally over 2 decades to this route. So it's extremely safe and custodized with Apex. We also have an ISIN number, which means the fund's globally tradable. So all of that is fairly clean, and regulators are fairly strong in the western part of the world.
Right. Question from Shiva. I'm considering returning back in the middle of 2021. Do you have a roadmap for prospective returnees in the short term, say 6 months to about a year?
Yeah.
Prateek.
I'll just take this question. We can help you plan your retirement or your journey back to India. Obviously, there are a lot of things. What we need to understand is, obviously, what has been your status in terms of your previous year, whether you've been NRI throughout, or you've been coming to India. If you've been NRI for last 7 years, or 2 out of 3 years, then you get additional years to ensure you can get your funds over next 2 years. Also, next 6 months, 1 year, we can discuss it out. What is that you are looking for? We can definitely handhold you and completely guide you in terms of your journey back to India.
Okay. Last 2 questions I'm just clubbing together from Shiva itself, and it is, do you help in early retirement options? I'm looking to work for some years in tech sector, but on a more non-regular basis. I'm 45 years old, maybe looking to work for another 5 years more before retiring. That's the first part. Second one is, if I had a 3 BHK apartment, say in North Bangalore, what would be a good rental income post or during COVID? Also, ideally, is there a percentage of funds allocation that you recommend in stocks, gold, real estate, etc.?
Okay, I'll answer the first question, first. So yeah, we do help with the retirement planning, which I discussed briefly in my presentation. But yeah, we go, one-on-one with clients. We try to understand what is that investor is looking in terms of, client is looking in terms of retirement point of view. We can actually guide them, and specifically, depending upon when you plan to retire, and obviously plan your entire cash flow out in terms of your retirement. And we are very conservative in terms of planning your retirement, so we take in conservative estimates, whether it's inflation or the cost of living, and which ensures a very smooth retirement phase for you. So definitely, Shiva, we can connect, you can write in to us, or we can get in touch post webinar, and we can take this one on one. We can definitely guide you. Your second question, in terms of if I were 3 BHK, what will be a good rental post COVID? Okay, a difficult one, but yes, rental yields have definitely come down. So depend upon that specific market, but average yield has been about 2 to 3%, depending upon the property, construction, developers. A lot of factors also move in around that. So it will be 2 to 3%, not very high yield on the rental side of it. Um, Also, and last part was any ideal percentage fund allocation you recommend in stock, gold, bond.
Right.
Obviously, that would depend upon the age and the risk profile of your. So ideally, as someone who's say a 50-year, would should have not more than 50%, 60% in equity, 20, 30% in bond, and probably 10% in gold. So ideally a 60, 30, and 10 in form of equity, bond, and gold. So 60% equity, 30% bond, and 10% gold. But it would depend, depending upon your risk profiling. What we do, we need to do a proper risk profiling of yours, which is available through our software, our website. You can register and do your own personal risk profile, which will give you your equity, bond, and gold exposure, what you need, depending upon your question or what you answer.
Brilliant, brilliant. Thanks a lot, Pratik. Yeah, so with that, we've come to the end. We've covered almost all the questions. And gentlemen, you've covered pretty much the entire spectrum. Beautiful presentation, loved it. For those of you who are listening, we'll be sharing this presentation on our YouTube channel, so feel free to check it back later. Just a quick thing. So there is an email address that I can share in the chat screen. So basically, if you have any questions or any queries on whatever was talked today, feel free to contact at this email address. I'm just copy pasting it here. I hope you can see it. So that's rajeemol.jr@tiwpe.com. So that's the email address you can reach at if you have any questions at all, and they'll be able to help you. But also we have the contact address, the phone number, email address of Alphabet Investment. So if you have any questions to Pratik, feel free to shoot it his way as well. But yeah, wonderful session. Thanks a lot. I hope this was very useful. It was very useful for me. I'm hoping that you also found it useful. Let us know what you think about it. Please write to me, share in the community as well. But yeah, if you guys have any questions, feel free to either contact at these numbers and email addresses. Also, if you want to ask anything to me, feel free to. I'm more than happy to share the contacts with both of the gentlemen offline after this webinar. So yes, that brings us to the end. Thanks a lot, Mohit. Once again, thanks a lot, Pratik. It was incredibly useful. Thanks a lot for spending time with us.
Thanks, Mani. Thanks. Mani, there
Thanks,
was one
Mani.
last question. There was one
Yes.
last question. I know someone is saying, yeah, you can approach us for any doubts, any queries with related to TIW also, as well as us, anything to do with taxation, referring to US NRI taxation, planning your investments with related to TIW, private equity. Please do reach out to us. My mobile number, WhatsApp number is here, as well as email ID is here. You can write in to us. I'll also share my personal email ID, which you can write in any point in time, and we'll be more than happy to help you out. And also sharing my website. Website is there, actually. It's mentioned. No, it's on the another page.
It's
I'll share that also.
alphabet-investment.com.
Hyphen, yeah, alphabet-investment. I'm just sharing on the.
Yeah, feel free to share in the chat as well.
Yeah.
Wonderful.
Yeah. Thanks, Mani. Always pleasure to connect back with the community, and thanks for giving us an opportunity to
Sure. I have a feeling
share
we'll do more of it.
Absolutely.
Yeah. And thanks a ton, Mani, and thanks, Prateek. And as always, for everyone's benefit, Prateek's very close and known associate. So feel free to coordinate with him also for anything to do with TIW and his firm. And Mani, really kind of you to invite and give an opportunity to speak. It's always a pleasure to talk to people globally, and have a great weekend.
Sure. Incredibly useful. Thanks a lot, guys. Have a good
Thank
good
you.
night.
Thank you. Thanks,
Thank
Mani.
you.
Thanks
Take
a lot.
care.
Thank you. Take care.